Hello, I'm Michael Kopinski, the Director of Research at Noble Capital Markets. In this corporate profile program, we uncover companies that are out of favor or underfollowed. Today, we're taking a look at a play on precious metals, ELY Gold Royalties. The stock symbol is ELY. It trades on the Toronto Venture Exchange, and ELYGF on the NASDAQ. This company has a market cap of about 100 million. ELY is a Vancouver-based emerging growth royalty company, which is a unique way to play precious metals. It has a focus in the state of Nevada. In this program, we'd like to uncover what are the advantages of owning a royalty company rather than a gold producer. As an investor, would I be exposed to more risk or less risk in fluctuations of gold prices? Does a gold royalty company with a large number of properties decrease operational risks? We're fortunate at Noble to have an expert, mining analyst Mark Reichman, a best on the street all-star analyst as surveyed by the Wall Street Journal and by Forbes magazine. He will interview Trey, the CEO of ELY Gold Royalties. And before I turn it over to Mark, I encourage you to stick around for closing comments when Mark and I will discuss the key takeaways from this interview. Gentlemen, welcome to the program.
Thanks, Michael, and thank you, Trey, for joining us. Well, Trey, gold prices have been rising, and my first question is, what is your outlook for gold prices, and how does ELY Gold have leverage to rising gold prices?
Well, let's start with the backside of that question, Mark. As a gold royalty company, our revenues on our producing royalties go up, and the value of our the net present value of our royalties that we'll be producing over the next few years goes up. And at the same time, our costs don't go up. So a royalty company like ELY that is all of our assets are in gold and all of our assets are in Nevada, so they're currently not, on any kind of work stoppage, and we're very leveraged to the price of gold. As far as what's going on with gold, I've been having a lot of conversations. I generally keep my head down and don't make predictions about where the price of gold is going. We just generally think it's that our shareholders and investors are interested in owning gold. We don't really sell them necessarily on the commodity. But boy, these are different times. Things are all over the place. We had gold drop back suddenly from a 12-year high right after this pandemic. Market started tanking, and that was kind of a case of where people were getting margin calls and selling what they could. We then had gold, and the gold stocks all bounced back up. Something never seen happen in such a short period of time is the gold stock indexes dropping as much as they did, and then recovering and going to a new high all within a week. So at crazy times, and I think that my long-term view of gold at this point is I think what's different this time, as far as all of the stimulus that we're seeing, is that it's being injected really at the consumer level. In 2008, it all went just to shore up the banks and to bail out Goldman Sachs for the government making them purchase AIG, and Bank of America buying Merrill Lynch, that type of thing. So this time, on top of that, the fact that stimulus is really going into the economy, with the fact that we are seeing some supply chain disruptions, and so goods are, I think we're going to see spot shortages of goods, and I think you're going to see price increases and some real inflation start to kick in. And so, while gold's, I think, initially here been going up as a safe haven, I think it's also going to be an inflation hedge.
Well, Trey, investors have a lot of choices, and I was just wondering if you could touch on the advantages of owning a gold royalty equity versus a mining company's equity versus bullion or an ETF?
Well, the bullion or the ETF, I mean, you have just the the price of the gold, the direction up and down, with no leverage. What you get, in fact, you get a little less leverage. I mean, a little less than equal movement in the gold ETFs for the physical metal. But with the so to get leverage, you get into the equity market, and I think if you really want exposure to gold, you want to look at gold producers, ones that actually have the mines and are making the gold and benefiting from higher prices. And beyond that, the even better investment is gold royalty companies, because as I mentioned, when the gold price goes up, our revenues go up because we just get a percentage of the gold that is produced at the mine. If I have a 2% royalty, 2% of the gold sales go to us. That doesn't include any, that's just at the current price. It doesn't matter whether the mine has hedged and sold forward their gold. It doesn't matter if their costs go up, or we take that percentage off the top. And meanwhile, our expenses don't go up. With the producers, they have changes in labor costs and inflation. I mean, right now they're actually benefiting from low oil prices, but our overhead stays very stable in a rising gold environment.
So in other words, you really can thrive in a rising gold environment, and you're better positioned to weather any challenging market environments. Well, let's just start off with maybe explaining how royalty companies obtain royalties, the different types of royalties, and how your company differentiates itself within the industry.
Okay, well, basically, there's three ways that you see that royalties are acquired. The first is if a property owner owns a property, sells that property to a mining company, and retains a royalty. The second way is, and this is where traditionally the larger royalty companies are participating at the financing level of a new mine or a mine expansion. They'll come in generally with bank debt and some type of a royalty or stream, and the banks like that because it's more like equity, and that the banks, they get paid their interest, they get paid their debt back. But if there's any production delays or anything, the royalty companies, of course, don't get anything until the gold is actually being produced. So those are the typical ways, and then within that there is the ability to buy royalties from the third parties, either the people who created the royalty when they sold the property in the first place, and that could be an individual or other gold companies that have sold properties and kept a royalty back, and that's really where we are playing. We're not we're in the junior royalty space, so we don't have the capital to be a big part of a financing package for building a new mine. So instead, we are purchasing royalties from third parties, and we only purchase royalties where we can see either current production, or very near term, say over the next 3, maximum 4 years, that royalty will actually be producing. And then secondly, we are one of the largest property owners in Nevada. So we, for the last 3 or 4 years, have generated quite a few royalties through the first situation that I mentioned, which is that we sell the properties and retain a royalty. So of our current portfolio, We've got 43 royalties, and of those, we've probably purchased about half of them, and about half of them we've generated through property sales.
So based on your existing portfolio, what are the current producing royalties and those that are expected to produce, say, in the next 2 or 3 years?
Yeah, if in our most updated presentation on the website, we talk about we have as our 11 key assets, and these are the assets that we think will all be. 3 of them are currently producing. That would be at Jarrett Canyon in Nevada. We have a 0.5% NSR, and we also have a per ton royalty on everything that goes through the mill there. And then on the Isabella Pearl mine, operated by Gold Resource, we have a 0.75% GRR, a gross revenue royalty. And those are the 3 that are producing. The other 8 of our 11 key properties are scheduled to come into production anytime from later this year in the case of our Rawhide net profit interest, and possibly the Walbridge Fenelon, and then through 2022 and 2023, we expect by 2023 we think that all 11 of those assets will be producing. And that's not based on our projections, it's the projections of the companies. And you know, we have a very high quality portfolio with our throughout really, but just very strong partners. So those 11 properties are all at existing mines, or they're mines being built by operators that are active in Nevada already. So, you know, even some of the smaller ones like the Gold Rock, Fiore is operating the Pan mine about 10 miles away, and they just came out last week with their PEA and projections for production there in 2022 or 2023. So we've got very high quality partners on our counterparties with all of our assets.
Well, now you have interests in the United States and Canada, but most of your assets are located in Nevada. Do you think over time your asset base will become more geographically diversified, or is that really by design that you have kind of a specialized knowledge of Nevada and there's some real benefit to focusing in that state?
Well, you know, look, we love Nevada, and we do have quite an expertise there between Jerry Bachman, who runs our royalty and property portfolio out of the Reno office, and one of our directors, Bill Sheriff, has spent a lot of time in prospecting and generating properties in Nevada. So we know the landscape there. We know the projects very well. We have a huge database that's been accumulated from companies going back into the 80s that that we operate out of to generate our properties and data packages to sell the properties. But when we see opportunities like the Fenelon royalty up in Quebec, you know, we certainly we've gotten to know that asset very well. We are a Canadian company, so we have a fairly large tax loss carry forward from our exploration and development days in Canada. So there's tax benefits to generating revenue through royalties in Canada. So I think you'll continue to see us picking away at things in Canada. Getting outside of that, you know, is a little bit more difficult for us. But look, if it's a paying royalty in a good jurisdiction, we certainly take a look at it. But you know, for the time being, the thing that is maybe most attractive about Ely Gold Royalties is number one, that we are a gold royalty company. All of our assets are gold. You're not going to see any iron ore or even much silver is just a little bit of byproduct there. So we are a pure gold play. And then the Nevada focus. Nevada has some of the largest mines in the world. They're still discovering some of the largest mines in the world in Nevada. It's easy to get to, inexpensive for us to operate. And again, as long as we keep seeing opportunities like we have been in Nevada, I think you'll see us continue to stay focused there. It's the #1 mining jurisdiction in the world, and if Nevada were a country, it'd be the 4th largest gold producing country in the world. For the time being, we're very happy being gold focused and Nevada focused.
Well, and you know, there's a broad representation of really high quality operators represented, you know, among the properties where you have royalties. And I think a lot of investors looking at your presentation will probably notice, like Jarrett Canyon, you have multiple royalties on certain projects. And I thought it might be helpful to kind of explain your asset level focus, which you know, I think is kind of a differentiating factor in that you're able to really build relationships with companies and increase your leverage to certain projects that you deem as high potential projects.
Well, look, Mark, there's no question there's a method to our madness here. And when we're smart about the projects that we're generating, and you know, we try and focus on properties that are at or near producing mines. So when you get below, a step below our 11 key assets, and look at our list of I believe it's 22 development properties, 14 of those properties are at or near existing mines. So you know, we're in a situation there where we don't have to, you know, our properties don't have to become big enough to warrant building a mine. The mine's already there. Our properties are going to get, and our royalties are going to get paid on whether they find 100,000 ounces or a million ounces. We'd prefer them to find a million, of course, but you know, if it's even at 50 or 100,000. And so when you look at property packages that we have at McEwen's Gold Bar Mine, we now have 5 different royalties on 6 different properties in there. 3 of which we know there's gold on, so it will eventually get mined. We're not modeling that in yet because we haven't heard from McEwen that they are planning, you know, to start production on any of our properties. But the same would be the case for Gold Resource at Isabella Pearl. We have the producing royalty now on the main ore body there. But we also staked and then sold to Gold Resource all the expansion ground at Isabella Pearl, where they're currently doing expansion drilling. And we sold them 3 satellite properties, Mina Gold, County Line. Both are former producing mines. They're both about 10 miles from Isabella Pearl. And those are projects where you know, we know there's 50, 100,000 ounces there, historic from, you know, when they stopped mining at those 2 operations. And now Gold Resource, that's their model. They've done it in Mexico, started 10 years ago with a small mine with about a 4-year mine life and producing out of about a 500 ton a day mill. 10 years later, they've been producing, they've been profitable every year. They're now operating out of 2 mines and doing about 17, and 2 mills, doing about 1,800 tons a day. And they have a 6-year mine life. So while Isabella Pearl is starting out slow, it's going to expand, and it's going to expand and we think over the next 5 years, possibly more, we'll be paying on 2, 3, maybe even 4 separate royalties in there Isabella Pearl Nevada mining unit.
Mm-hmm. And you know, another point of differentiation is your royalty generation program. You know, where you're basically putting properties under contract and providing an opportunity for the mining company to have the option on it. And I thought maybe you might want to explain kind of how those property sales contracts work. You know, what's your success in terms of the number of companies that actually exercise the option versus those that don't, and how you seek to kind of replenish your inventory of properties.
Yeah, look, we in our royalty generation program and our property portfolio, we don't do any joint ventures. So by selling the properties outright 100% and retaining a royalty, it's a very scalable model. So with the small team, Jerry and myself, you know, we can manage a very large property portfolio, because basically once we sell the property, we either sell it outright and retain the royalty, or we sell it over a 4-year option contract. And either way, once the contract is signed, all we do is send them an invoice once a year. So a very manageable model for us. We haven't seen all of the, you know, we started just 3.5 years ago. So it's just this year that we're going to start to see some of these projects start to roll off out of the option portfolio. And most of those, said we've got several of them that are at or near producing mines, but I mentioned the 4 projects at around Isabella Pearl for gold resource. Those were all sold for cash. I think we generated just under $2 million US in property sales to them, and each deal, those were not done under option. So, but some of the ones that we have under option today that are very interesting is some property in the middle of Premier's South Arturo mine. That's a joint venture with Barrick. The War Eagle project at Delamar, Integra's project. The Gold Canyon is under option to McEwen. All those properties are properties that we feel very comfortable are going to be, you know, the options will be exercised. We have about a dozen properties in the option portfolio, a dozen of the properties. Well, I wouldn't say a dozen, probably 8 to 10 that are in fairly weak hands with junior companies that, you know, that we're not sure they're going to be able to raise money and what they're, you know, what they're going to be able to do. But those are all good properties. So to the extent we get them back, they're under the option model, it's 100% or nothing. So if they don't do any work on them, but make the option payments to us, and they don't make the last payment, we get the property back 100%. And you know, so it's a little squishy there with some of those, with a handful of them. But those aren't properties that have been properly explored either. So, you know, it's been some junior companies that kind of ran into this market, you know, starting in 2016, 17, were able to raise some money, and then the last couple of years, it's gotten harder and harder for those companies to raise the money to do much exploration. So,
well, the nice thing is if the option get exercised, you know, that mining company is spending the money to develop that mine, and you'll have the royalty. Meanwhile, you've received these option payments, which has provided you with capital to reinvest in your business, whether that's going out and buying a producing royalty, but it sure helped in keeping your share count tight, you know, from a financing perspective, which leads to the next question. How would you characterize ELY's financial strength and liquidity, considering the company's anticipated growth needs?
Well, look, there's no question for us to keep growing. We're going to have to keep tapping into the financial markets. We have a very disciplined approach to that. The sale portfolio, as it now stands, about covers our our G&A. You know, as we see more royalty income, we'll have the ability to have capital from royalty revenue. But you know, we currently, late last year, Eric Sprott gave us a $6 million line of credit. We'll be tapping into that to close the VEK transaction. But you know, when you and then you may see us at one point in the capital markets to pay down that that line of credit, and then have that available the next time we see an opportunity. The idea with the line of credit was that as opposed to just going out into the market and raising money to have it in the bank, we had the line of credit that we could draw on when we saw a specific deal and let the market absorb and get the impact of and benefit of that purchase, that acquisition in the marketplace, and then have a less dilutive financing to pay down the line of credit. So you know, I think, but the strategy that we use, and if you use the VEK transaction as an example, we're about $100 million market cap right now, a little under. I mean, stocks moving around, but you know, 90 to 100 million. So VEK transaction is 5 million, so a little less than you know, somewhere around 5%. But that transaction between just the two royalties, the Ren and the Marigold, we're going to get about a 30% internal rate of return on that. So if we can, well, you may see us diluting more in the capital markets, but if we can stay with our strategy of getting those high internal rate of return on the assets, then, you know, diluting the shareholders by 5% for a 30% IRR, that's you know, that's a net 25% growth in that asset, you know, year over year.
Well, you know, I thought we'd talk a little bit about what were some of your key goals in 2019 that you achieved, and what are some of the goals that you have outlined for 2020?
Well, you know, the 2019 was really a breakout year for us, and of course the stock really reflected that with some very nice growth for our shareholders. But you know, our main goal was to purchase 4 producing or near-term producing royalties, and we ended up purchasing 4. We entered 2020 with the same goal, and we've actually purchased 8 in the first quarter. Now, of those, 5 are what we would call producing or near-term producing. So we've already exceeded that goal. Another goal we had last year was to increase our U.S. and European investor base. So I was in Europe a couple of times last year at shows. You know, we got in 2018 got the OTCQB listing, and when at the beginning of last year, we traded most of our volume, which was 80,000 shares a day on the TSXV, and today we've built that trading up where we're trading between 250 to 400,000 a day on the OTCQB and the TSXV individually each. So the goal for this year was to continue that and to secure some investment bank research. So with Noble Capital Markets picking up research, we've got halfway at least to that goal. And then lastly, late this year, it's going to depend on the market, and I've really made this a late 2020 or 2021 goal, is to institute a dividend program.
royalty businesses have been pretty popular with investors, and I thought it might be a good time for you to talk about. I mean, why is now a good time to consider an investment in Ely Gold Royalties? I mean, are you at a stage where you know, obviously the growth has been pretty healthy the last year? When you look at royalty companies, I mean, do you think that there's more upside in the smaller royalty companies than the larger? What are your thoughts on that?
Well, look, there's no question that it's easier to build a company from 50 to 100 million than it is from 500 million to $1 billion. You know, it's all in the size of transactions and the access to capital. So we are at a kind of a sweet spot. If you look at royalty companies historically, and again in our presentation, you'll see I've got a few charts in there of Royal Gold and Franco-Nevada, two of the largest royalty companies, and one of our peers, Abitibi Royalties. And you know, with Franco and being the largest royalty company today, I think Royal Gold's probably number 3. In their first 4 years in business, Royal Gold was up over 3,200%. Franco was up over 3,700%. Abitibi was up about 3,800%. So while our stock was up about 500% last year, we still think we have a lot of upside in that, you know, we're still in that place at a $90–100 million market cap, where one, we're undervalued when you look at us compared to our peers. You know, somebody like a Metalla, you could compare our portfolio compares very favorably to theirs, yet on both the quality and the number, and yet we're trading at about 40% of their current market cap. So we think we're undervalued to our peers and due for re-rating. We're also at that sweet spot where, you know, a $5 million transaction with high quality, high profile royalties in it, like the VEK transaction with the Marigold and Wren, or the Jarrett Canyon acquisition. These move the needle. Each one of those still moves the needle for us. A $5–10 million transaction for, you know, a $500 million company is just, and especially for the bigger, you know, Franco-Nevada, I mean, that's you know, it's petty cash. So we're at that place where you know, we fly a bit under the radar. We're able to find transactions that maybe are less competitive, certainly with the big boys, but we compete more with our peers on those. But again, that you know, I think the idea of us being with Metalla at almost, I think they're about a $280 million market cap. I haven't stated this as one of my goals, but I guess I could state it here is that in the next 12 months I intend to catch them. So we'll see, but still a lot of upside. And historically, looking at royalty companies in their early years, you know, 30–40 baggers is commonplace, not unusual.
Well, I think Ely Gold certainly is a compelling story. And Trey, we really appreciate your insights and thank you for your participation.
All right, well, thanks for the interview, Mark.
So Mark, that was a great interview. And Trey comes off as very well spoken and very articulate, very knowledgeable. And I was just wondering, in terms of just, if you look at Ely relative to the other companies, how does this management team compare to some of the other companies in his peer set?
Well, I think it's interesting because Trey the company offers, really the management team has a unique blend of capital markets experience and industry experience being on the technical side. And so Trey really is the one with the markets experience, and Jerry in their Reno office is really kind of the landman who does a lot of the technical work and field work, whereas Trey is closing the deals. But I think what's kind of unique about this company is during the interview they mentioned the focus on Nevada, and obviously Nevada is a very favorable mining jurisdiction. There's a lot of big mining companies there, so it's very fertile ground for gold and for a royalty business. But they really bring to the table a specialized knowledge of the state, and so they know Nevada very, very well, and so they've been able to identify a lot of opportunities that may be missed by others. And so I think the other thing is that they have kind of a differentiated business model in that they are generating royalties through their property sale program, which we discussed during the interview. And I think that is kind of a key differentiator. And also within the junior space, they have they've been very active in the last year or so in terms of building up their royalty portfolio.
Gotcha. And there was a lot of discussion about his valuation relative to his peers, and then there was a discussion which I caught my ear was the diluting of shareholders. And so, where does this company set relative to its peers in terms of capital raise and in financing and so forth? Is that the differentiator, do you think, or I'm just kind of curious why you think that there might be a valuation gap?
Yeah, I think when he talked about the re-rate opportunity, really what he's referring to is when you're moving from being a junior royalty company, with a market cap of less than 300 million. Of course, they're just under 100 million. To moving to a mid-tier, mid-sized royalty business to a major, so and the same is really true among mining companies. A lot of mining companies are focused on growth because they hope that that the market will value them higher as they grow. But I mean, in terms of the investment opportunity, and I think he highlighted this, there's a lot of opportunity. Investors are really interested in these smaller companies that are able to make the leap, in terms of growing their royalty portfolio. In terms of the dilution, really, from a financial standpoint, that they're in really good shape because they have really kind of an anchor investor in Eric Sprott, who really provided a $6 million line of credit. And so they're very well funded for their 2020 growth initiatives. But as far as their the royalty universe, I mean, you've got larger players like Wheaton Precious Metals and Franco-Nevada up on the as kind of the major royalty companies, and then ELY, Metalla, some of the others that are at the smaller. And so I think the hope would be that they'll grow their portfolio, and a greater percentage of their revenues will be recurring royalty revenues, revenues that are being generated off the from their from mining companies' mines that are in production. And then once they're able to grow the revenue, then at some point they would entertain declaring possibly a dividend, which a lot of royalty investors are interested in.
Now, the focus on the dividend obviously was one of his goals. He mentioned it. Are the other companies paying a dividend? Is that a differentiator as well, or no?
Well, they are, but in some cases, like he mentioned, Metalla, if you look at their cash flow statement, I mean, they're not generating, at least in their most recent, they're not generating sufficient, free cash flow to cover the dividend. I mean, it's basically being financed, and so I think that To me, the dividend, I think some people will differ on that. I think a dividend makes sense if it's meaningful, if it's sizable. When you're looking at a company like Elys, just given where their stock price is, I mean, even a 1% yield would be a pretty small dividend payment. So I think they'll look at it, perhaps evaluate it in 2021. I think he talked about late 2020, but I guess for me, I mean, I think that it makes more sense. I mean, I think investors will see the progress in the portfolio, and they'll see these new producing royalties coming on stream, and that at some point, that the cash flow is sufficient to, for the company that would support a dividend. But yeah, that is the goal, and certainly, they've got a lot of projects that will come on stream, and so you will see certainly revenue growth from this company just as a result of the existing portfolio that they have in place.
Well, Mark, thank you for your comments, and thanks for bringing Elys Gold to us. I really do appreciate that.